Welcome, everyone. Welcome to the Hurley Investments Market View Commentary for the 16th of September, smack dab in the middle of the month. We like to call it the high Market View Commentary. Let's get started. Right out of the gates, is this week all about a rate cut? Does this rate cut matter? Is it important? I want to hear what you think our markets will react to this week in regards to our rate cut. Give me your ideas. Let me know if you think the rate cut's important, if it's going to be 25 or 50 basis points, how the market's going to react. Give me your idea of what the rate cut is involved with. And John and Vicky Brenton, we're still waiting for you to type something in the question section or the chat section, where if you click on the little arrow, it'll be a drop down box for you, where if you type anything in there, we can all get to see it and we can make comments all together. All right, so I have right now, it's like you guys pay attention to me. It's only 25 basis points. So it really shouldn't matter. Mary, I agree with you, but is it the rate cut or is it the path of rate cuts in the future, right? Mod, the rate cut is whatever the market wants and Powell will do it. So to kind of shorten that one down, Powell is going to give us a rate cut. I agree, but will it move the markets like we think? Oh, Abraham typed in a bunch of stuff here for us. I'm going to give it the short and sweet version. In the end, it won't change the fact that the excess of liquidity in the markets need a place to go. Of course, it might have a bump, but it won't change much on the underlying situation. I agree. So, and this kind of was what Maud said. Markets will do what markets can't type. Markets want to do. Agreed. I think if it's 25 basis points, the market has that figured in. If it's 50, then there may be a short-term bounce. So 50 basis points equals a bounce higher. Elections might affect more. Agree with you 100%. Buy the rumor, sell the news. So, Maud, I agree with you, but we had a sell the rumor, and the markets were down like 4.25%. Then last week they were up 4.73, so it was a buy the rumor. We're still down net over the last 2 weeks in September by about 3/4 of 1%. So I would expect it to be a buy the rumor, sell the news, but we had such a big drop that first full week of the end of August and September that my tone changed right there. Okay, Jim Kohler, it won't matter much. Gas and groceries will not be impacted. But if you're charging your gas and groceries and you're not paying it off, does that mean that it will impact how you buy groceries and gas? I mean, you guys are all correct. In real life, a quarter point won't matter. So let me go ahead and let's type that in. In real life, a quarter point or a half a point. 50 basis points, right? Won't matter. So what does matter then? If I'm going to tell you that really doesn't matter, what does matter? What's going to make that average in the next 4 to 12 weeks affect our market? What could Powell say tomorrow, or excuse me, it starts tomorrow, it finishes on Wednesday. What could Powell say so that sorry about this, what works best so that we'll get a prolonged effect in our stock market? And the Brentons, I'm still waiting for you to click on the little arrow next to questions or chat so you guys can type something in. Ah, there you go. Love it, Stuart. Will Powell continue cutting for the rest of the year? That's it. Are we going to get a path for rate cuts for November and December? If you ask me, we already are offering monthly $1.2 trillion in treasuries. And only filling between 600 to 800 million at, well, just period. Most months we're only a little over half of it. So the government right now is not funding itself from the sale of treasuries. It's not funding itself with our taxes. It's kind of funny because we then say it's the president's fault, right? I'm going to blame Joe Biden. Can someone tell me where the purse strings of our nation lie? Where are the purse strings of our nation? Where do they lie truly? Gotta be Biden. He's old. He doesn't know what he's doing, right? Maud says Janet Yellen. Stuart says Congress. Where do those purse strings lie? There you go. House of Representatives. So it's kind of funny because we blame it on presidents to a certain degree. We blame it on Trump. We blame it on Biden, the Bushes, Obama. Fact of the matter, it really relies in the House. So if it's the House, then the House is where it comes to pass that we are truly the ones responsible for the budget. I don't know, Brentons, if you yet are able to type anything in. There are a new couple that's with us and joining the Hurley Investments family. Go to that question section and click on the little arrow and it will do a drop down where you can type in a larger rectangle box, or it might be listed as chat for you. I'm not sure where it's at. But Kiva's typing to the entire audience through the chat session. And there it is. John just says welcome. So all of you that just said hi to John and Vicky, they're on with us. They're typing things in. We're all together. We only have about 42 people, 44 people with us here tonight. But okay, so correct. My concern, or I'm just going to say my worry, right? My worry is if interest rates go lower, how much more deficit will we create for our country? That will be the question. And the good news is that for the most part, after a rate cut over the next 12 months, the S&P on average gains somewhere between 5.3 to 8% roughly. So it's a bullish indicator for our stock market. Yes, I told you guys early in the year, it makes no sense for us to cut rates. Could it affect the election? Of course it can. Most definitely it can. But I guess that's the price we're going to pay this year going through. I can't remember the last time we did a rate cut or hike in an election, but I want to say it goes all the way back to Carter. Don't quote me on that exactly. All right, let's talk about tech right now. Tech rolling right now, or has it lost its leadership? If we take a quick peek at the NASDAQ, the NASDAQ is technically bullish. And even with Apple having a lackluster first weekend sale on their iPhones, look at how close we came to touching the 50-day simple moving average and bouncing back above it. If we were to move that to a little bit bigger chart, let's change this to 3 months so you can see it a little bit better. Look at how today, even though we were down, look at how we came down and touched the 50-day. The big institutional buy or sell. We touched it almost to the dollar. The 50-day is at 17,496.73. The low today was 17,480.66. We missed it by 4 points, and it bounced off of it. So, someone tell me, technically speaking, in the NASDAQ, what would you call that 50-day moving average if we're bouncing off of it right now? And in a week, we changed from bearish to bullish, although I think we put bullish last week. What is that technical indicator? When we see it come down and hit that 50-day and bounce back up higher to end the day. What would we call that 50-day simple moving average, that blue line, which is a very important institutional traders reference point? Anyone know? Support, bingo. We have a new support level at 17,496 to 17,480. Question is, how many new orders were put there? The good news is it almost held for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Almost held for 13 days. And it's had roughly 2 months to build a base and to get orders in. Those orders usually take somewhere between 2 to 4 weeks to start to create an order supply at that level. We did not hold it roughly 2 weeks ago, even though we had 13 trading days. So here's the question. What do you guys think? Has technology lost its leadership in the stock market? Will technology continue to go down through the rest of the year, or will it go up towards the end? What do you think? What do you guys think? Has technology lost its leadership? Or do we have support and will it run up through the rest of the year? Stuart seems to think it's going to run higher. Mary thinks it's going to run higher, but Apple had less phone sales for their initial order, like by a lot, by a third-ish of what was expected, by about 25% of what people expected them to order. Mary says up, William says, yeah, we'll bounce back in the last quarter for Kohler. I think so too. I would say expect leadership because of the historical Christmas rally. Let's face it. What are we wasting our money on for those little whippersnappers? iPhones and computers and this and that. I would expect tech, like they typically do, to run into the end of the year. So yes, we're out of Meta, but we still have positions in Apple, Micron, NVIDIA. We are in half of the Mag 7. And someone just typed in, confusing how it was done with the iPhone, right? Let me just throw this out there for you. There are going to be some articles. I will find a couple and put them in with my notes. The iPhone is fabulous for camera and memory time on their battery, but the extras, the artificial intelligence and so forth, Apple's behind on. Apple's probably 6 months behind on. And like Apple now, they're matching the crappy. The phones have just as many problems now, it seems like, as an Android does when it's first released. The good news is Apple seems to fix them. For an Android, because it's Android based, you just have to reset, turn your phone off and turn it on again. And that usually rights the ship for Android phones. For Apple, they're going to suck for their first couple months as they put updates, and you'll receive a ton of updates to make your phone work better. But let's face it, Apple no longer gets out a phone and is perfect. It has its issues just like Androids now. My only advantage, I think, to an Apple phone is some security and the fact that you don't have to keep shutting your phone off and turning it back on to get the updates to work like an Android phone does. Okay, a couple of you asked me via email, how did you know? I had no clue Apple was going to open up $6.68 down today. It finished down $6.18. But yes, we kept protection on Apple. This is one account, 3,000 shares. It was down, let's see, $18,540. Yes, we made up $8,325. I like that number. That number of $8,325 divided by 177.25 gives us 46.9 shares. Almost gives us enough money to buy 50 more shares of Apple. Did Apple deserve to go down $6 by selling 25% less iPhones on their initial weekend than analysts thought? My answer is no, probably not. That's not a problem. But thank goodness we kept our protection on. Kevin, how did you know? We did not know. What we did know, though, technically speaking, if we are looking at a chart, Keeve and I struggled for 2 weeks. Do we take the protection on? Do we leave it off? It's a little bit lower through an earnings event, right? But technically speaking, we didn't take it off because it's below the 50-day, below the 50-day, below the 50-day, below the 50-day. Every single one of these days, Keeve and I are waking up hour and a half before the market opens, looking at Apple going, for crying out loud, what's it going to do? Well, we hope it comes back down here to touch the most recent low at $200. That's where we're planning on taking off protection. If it jumps up higher, then we protected ourselves for today. But plain and simple, we had no premonition about Apple. We just knew, hey, it didn't get over the 50-day simple moving average. That's a huge institutional indicator. So we kept protection on. Micron, how do you know about Micron? Well, again, we took a huge profit last Wednesday or Thursday. Definitely go back and look at Keeve's 25 minutes on Micron that he spoke about last Thursday. But the reason why we did not take Micron protection off is because if you look at the chart, it's going to show you the same thing. There's no big secret where, hey, these guys have insider trading knowledge. Hey, these guys are amazing because they just know what to do. No. What we see is this red line, the 200-day, an even bigger resistance level. We have not seen Micron make a significant movement up to test it. We also have a problem. The 50-day is crossing below the 200-day. Well, Kevin, it looks like it's crossed below it. Not yet. It could get a bounce. But the short answer is we're looking at a technical death cross. When the 50-day crosses a 200-day, you normally have between 11% more down next 6 months. Do I think that will happen? Probably not. They've had great earnings, great chips. We've got a huge earnings coming up for them in October, I believe, or no, it's Micron, the end of September. Once again, they're going to say they sell a ton of chips, helping out NVIDIA. They're the best of the best, and you'll probably see it go higher. Reason why we took it off at the 100 level, we were just rolling it down. We rolled it from 106 down to 90. And we've kept it at 90. We've kept it at 90 just to make sure because we haven't seen it break above it. In fact, again, same thing with Apple. Keeve and I get up every morning. Couldn't break 90, couldn't break 90, couldn't break 90, couldn't break 90, couldn't break 90. Last Wednesday, it's moving above 90. Should we take it off? No, we're going to wait for 2 to 4 days for the trend to prove itself. Down day. Thank goodness we didn't take it off. Last Friday, do we take it off? No. The trend for Micron has not proved itself. We don't have 2 to 4 up days. Not only that, we're getting that technical death cross indicator between the 50 and the 200 day. And it's a too money when you see this. Typically sell it on another 8 to 11%. So we kept it on. We will continue to keep it on. We took a huge profit from 106 down to 90. Nice to make almost every penny on the way down there. Did it help us about 50% today? It sure did. On 1,100 shares, 4,444, we were able to make up $2,060.50. If on 600 shares, Micron lost $2,424. We made up $1,125. We have these out to October 11th. That's 3 weeks longer than the earnings event. We've had it on for about 2.5 weeks. I guess it's 1.5 weeks, right? Maybe only half a week. I got to go back and check. But we decided to keep it in place to get us through the earnings at the end of September. Our goal, how do we get excited to see things go down? The more they go down, the more this is going to make up those losses till we're going to be at 70, 80, 90%. Our expectation and our hope, going back and looking at Micron, there's no reason if it breaks that 82 range, it won't go all the way back down to $70 to $74 a share. We would love to see that happen to Micron. We'll continue to make money on the way down. We'll add shares. We'll reprotect the money for their earnings that are around September 25th. We're just going to keep adding more and more shares. Every time you guys see these big drops on Micron, and they are really nice drops, that's just more shares that we're adding to your account. 100% paid for by put protection. And at no time are we asking you to put more money in your accounts dollar cost average. That's the beauty of what we do here at Hurley Investments. All right, one last thing someone brought up. Kevin, will you explain to me some of our positions going back to your spreadsheet when you were working those numbers back in January, because it seems like we've already hit them. Yes, if you take a peek at some of our positions, for whatever reason this year, yes, we hit some target prices already on some of our stocks. Apple today closed at $216.32. We had our target high price of Apple at $212.96. We have already hit our target price for Apple. That's where we're going to expect it to be. If you were to look at how we adjusted, our target prices is on level H. Market would calculate at $212.96. Our target price that we can get to Apple is at $243.60. That would be about the highest we would expect Apple to be by the end of the year. Bank of America, target low is $30.68. The target high was $33.71. We calculated at the beginning of the year $39.81. Some of you are saying, Kevin, it's not going to get there. Today it closed at $39.10. Bank of America is at its target price for Hurley Investments and 20% higher than its target price that the market gave it at the beginning of the year. We like where Bank of America has gone to, and we will adjust our target price to previous highs of $55. Looking at Disney, this one's a little embarrassing because it's the reverse right now. Disney's at $91.85 where it closed. Our target high for the market, the JP Morgans, the average analysts, they calculated at $91.85. Our calculation by adjusting it comes up to 157.80. Most likely it will be somewhere in the middle of the 157.80 and the 91.54, not because their parks are doing better, not because they've changed some of their woke stance. It'll happen because they'll have $3 billion movies, which is their cash cow. Google market said it won't get higher than 136.94. That was the target price for Google. Google right now is trading at 158.06. Our target price was 180.36 because we did the research and we said it could go higher. It's already traded for the year, right? I know it was 166 a week ago. What's the yearly high? Yearly high, trying to find it for me. Yearly high. The 52-week high was 191.75. So yes, I still think Intel can come up to the 180.36 price that we calculated for you and showed you at the beginning of the year. What, on the 8th, I think we went through some of these. Kind of interesting. I want to go over a couple more. Under Armour, we said $9.75. Already hit like 9.25. Market's high was $9.96. It's vacillated up and down. Someone asked me on NVIDIA. Let's go to NVIDIA really quickly. And then I'm going to answer that question that you guys had there that just came in. All right. Someone asked me, Kevin, you did NVIDIA and it's like way off. Yes, we did NVIDIA and it's way off, but remember, our target price was like 932.40. And I'm pretty sure, let me find it for you. I'm pretty sure they did like a 10-for-1 split way up higher. So what was the split price on NVIDIA? It was 10-for-1 and NVIDIA stock split history. $10-for-1 in June of this year. Anyone remember what the 10-for-1 price was, what their dollar figure was? Short answer is yes. They hit their target price. Now that they've done a split, you have to recalculate your numbers. You have to go back to FinViz, right? Back to FinViz and NVIDIA. You have to re-input the numbers. PE is 54.83, 4P is 28.76. So those numbers have changed once you dilute their share count. When you dilute their share count, you have to go back into your calculator and put the new numbers in to get those figures that you're looking at. We said it's going to be somewhere in the middle, and our comment was, hey, we were choosing 45 for your new target price. Well, when you go through that split, something more in the middle would probably be a 32 to maybe a 35. Earnings per share has changed. It's no longer $7.57 per share. You have to bring it on a new diluted share price. Earnings per share is $2.13. Forward earnings is $4.06. You have to re-input the expected numbers. At 213, it lowers the price for NVIDIA to PE used. We need to change it to 30. Oh, earnings per share used. Forward pricing is 406. Current pricing is 222. Earnings next year, sorry, that is $4.06. So that's how we're changing our estimates, where our target price would now change to 129.92. That would be the yearly target price for NVIDIA. It's already traded higher than that. It closed today at 116.78. So that's how you have to recalculate your numbers on our spreadsheet to figure out where you're going to be. Again, we're not guessing, we're running the calculations. The big picture, pretty good article. I'm going to suggest you read this. This again is how inflation's come down, how it's more than time for the Fed, who's been behind the 8 ball, to play catch up. A very good article. My suggestion is you read it all. As usually, what's most important is what it all means. The stock market is in a good spot. Our economy is doing okay. It appears to see a soft landing. The Fed sees inflation coming down. Earnings estimates are holding up. The labor market is in relatively good shape unless you're Boeing or some of the big firms that have let a bunch of people go, right? It also sees secular growth trend in artificial intelligence possibilities. What it doesn't see clearly is an election outcome. And it won't until November 6th, right? Or is it November 11th this year? It won't until November. So this will be one of those years that if you want to know where the market's going to end, it'll be that last 4 to 6 weeks in the year that you might see half of its gains as it either rockets higher or as it gives up most of its gains as it plummets lower. We will be protected again through an election cycle. There's too much risk at hand. Micron's estimated earnings dates are coming up on the 25th. If you ask me where our markets are going to end this week, I'm going to say lower, only because I don't have faith that we'll get 50 basis point cuts from the Fed. S&P is still bullish. NASDAQ, as we just said, is now bullish, but there's some key levels we can pay attention to. Earnings this week, big earnings are on Thursday. Darden Restaurants, FedEx, and Lennar. Retail reports at New York Empire Manufacturing was supposed to be negative 4.1. Came in at a positive 11.5. Retail sales will be a huge indicator if our market will go up somewhat tomorrow. Usually nothing happens tomorrow. Nothing happens until Wednesday at noon, Mountain Standard Time, when the Fed comes out with its rate cut or its rate hike. This will be one where the rate chair speaks. So the rate speaking will come out, and that will be the big push to see if we get a continued glide into rate cuts. Jim, I'll go over that comment in just a second here. How am I looking to trade? Again, we've been taking protection off or on based on technical analysis. A very interesting article that was brought to me by one of you guys. Gasoline prices prices slide. Here's how here's how the stock market tends to respond since Jeffries. Obviously, prices are going to continue to go down. A really good article for those of you that have talked to me about energy. Please read through this one. And last but not least, BlackRock's Rick Ryder says to take advantage of this golden age for fixed income as Fed is likely to cut rates. I kind of chuckled because fixed income has sucked since what, 2009, 10? 0% we went down where it had no interest. A lot of what was interest bearing above 2% was high risk junk bonds, which a lot of those were junk. So what the title should be from BlackRock's on fixed income is, hey, if you get in right now, you might get 4.5 to 5% of interest on shorter term treasuries, on their ETF is a good one. But right now is the point where if you want to have some good interest for the next couple of years, 2 weeks ago is when you should have started rolling into higher interest CDs through banks, higher interest bond funds. You should have been rolling 2 weeks ago like we talked about. Now is the time to lock in those rates. If you haven't noticed, mortgage rates have come down the last 2 weeks. Interest for bonds has come down the last 2 weeks and will probably continue to go down throughout the rest of the year and into next year as the Fed lowers its interest rates. The lower the interest rate, the more money the less money you receive on your bond funds, on your CDs, on your fixed income part of your portfolio. We made the comment 4 to 2 weeks ago. That's when things should have been rolled. Passive management misses consistently over and over and over again on ways to lock in those higher interest rates. Just something you guys should have been made aware of. All right, with that said, questions. And the first one is going to come from Jim. Jim's question was, and actually, John, I'll have yours too. Labor Department. Labor Department numbers might not be accurate. Jim, how dare you suggest that how dare you suggest that the government might not have accurate numbers? I kind of giggle, but here's what it comes down to. Initial claims are still only at 232 to that 215,000 new initial claims a week. And the continuing claims have gone up from 1,755,000 to 1,850,000. So we're maintaining roughly 100,000 people have lost a job this year and have stayed unemployed. Out of a labor force of 70 some odd million, with new claims coming in, it seems like those people are finding new jobs. So the short answer is the labor data accurate? Of course it's not. We're talking about a federal government that does things on a rather delayed basis, and in all honesty, probably doesn't do the best job. The comment is, and Bill Brander's kind of talking about this on unemployment check, U3 versus U6, big difference. The question is, are those that are actively looking for jobs finding jobs? And that answer is no, but I'm going to be honest with you. There's some availability for jobs that the JOLTS numbers say that they could get a job if they were willing to look a little outside of their preferred employment. So, no, any economic reports are not going to be accurate. As I was making that comment, I'm going off of and looking at it as the Federal Open Market Committee is judging the employment. 4.2%. Unemployment does not seem to be an issue at this point in time. The initial and continuing claim numbers support that data. Yes, Bill, if you check the U3 versus the U6, or those that are trying to get jobs, it says that it's worse, closer to that 8% unemployment. But again, the JOLTS contradicts that one that says if they want a job, they could find one. With all that said, the job numbers look good enough for the Fed to cut rates. That's all I was saying by that comment. John, has the antitrust litigation been priced into Google? I would say most definitely. The question is, how much of a fine will they pay, and will it affect their bottom line? The answer is probably no. They will not pay a big enough fine that it won't be a one-off, and they will still make their numbers. Google looks like a great position to be in. Google, if we look at a chart, a selling opportunity, right? Oh, bad news. It's time to sell Google. I'm going to go with Google L. That's what most people will be purchasing. Yes, they are up significantly higher, all the way up to 191. Thank goodness we protected. This is your buying opportunity. This downward movement, the fear, how baked in is it? We're coming to, it's not a pennant. We're just coming to where at the bottom it's closing. If you're to see Bollinger Bands, those would also be pinching. It's probably due for a breakout one way or another. Historically, a lot of people are going to be using Google searches for Christmas presents. Amazon will probably look better. Facebook will look better for advertising. Advertising on Google will look better. Probably a great buying opportunity was at the 150. It is still a buying opportunity at 158 when it can easily get back up to 191. Is it built in? It's been paying for it. 191 down to 150. Let's do the math there. $41 divided by 191. It lost 21.46% of its value. If you believe in Fibonacci or Elliott waves or herd mentality, usually it's right around that 23.33% is when it is baked in when it comes to news. News that is not earnings news or detrimental to the production of their product. Yes, it seems like the litigation news has been priced in. Abraham, any opinion on Microsoft shares buyback? Abraham, how much money did they put to their share buyback? I do not remember. So how much money did they put to their share buyback? $60 billion. So this is kind of interesting. Here's my thoughts on Microsoft shares buyback. Billion really doesn't matter. That's going to be my first guess. Microsoft is trading at $431. I know I'm saying this tongue in cheek, right? Divided by $431. So they have the ability to buy $60, that's 10 times. The ability to buy back roughly 140 million shares. when they have a volume of 13.5, they can buy back their share count for 10 days. That actually is more significant than I thought. So short answer, 60 billion will most likely put a base at Microsoft somewhere in that 400 to 410 level, where if things hit the crapper on their earnings for any reason, you're looking at a pullback of roughly 5 to 7.5%. The opinion on the share buyback, that gives them roughly 10 days to buy back their 10-day average volume and to be able to, for all intents and purposes, artificially inflate that price like share buybacks do. I thought it would have been more significant. For some reason, I actually thought Microsoft was trading in like the hundreds of millions. So my thought was that they had a day and a half of stock price inflation, where they can inflate their stock price. The reality is they've got 10 days, which is more significant than most of the others. An example of what I'm talking about, if you look at Apple right now, Apple still has 160 billion. They're only 100 billion more than Microsoft. They're only sitting on a huger cash pile by 100 billion probably from Microsoft. But the short answer is that looking at Apple has a 60 million right now average volume, and that volume's kind of down. You'll see it has higher volume earlier in summertime. So the short answer is, doing the same math, 160 billion divided by 216 is 74. So yeah, these guys have about 3.5 days realistically, where if everyone was to sell it off, they could float the price for 3.5 days. And then obviously all of their share buyback would be bought up and gone. So Abraham, I don't know if that answers your question or not. Any other questions you guys have that I can answer for you? We are approaching that hour point. So for those of you that might not have any more questions, thank you for being with me tonight. I hope this was helpful and important to you. I will get this posted on my Hurley Investments so that you guys are able to see our notes, look at them, copy them, see them. I also have that recording done, hopefully by tomorrow, so that you guys can check any of this over again. But I don't see any more questions coming in. So guys, have a wonderful evening. Brenton's pleasure having you join us. Thank you for participating. For those of you that don't know, there are a couple lawyers, so they're going to keep me on the up and up so that everything I say is 100% factual. They promised me that. All right, sounds good. In part, yes, they still question then why they don't invest to increase the effort in AI, but I presume you know better than me. So Abraham, the question for you on what companies should put more money into the growth of their business, but they found a way to artificially inflate shareholders' value by purchasing back their shares. Yes, if any company, standard business practices would tell you reinvest in the company, but shareholders and the the pressure that CEOs and CFOs are on right now, extra cash for a share buyback has been more important and artificially inflated or created a bubble in some stock prices. That's usually the creation of bubbles. Although some valuations are justified when you look at the income that they're bringing in. So yes, would it be smarter to increase their dividend, a one-time special dividend, and or put that money into generative AI growth, bigger factories and so forth? Yes. But you sometimes have heard maybe in the past, the law of averages or the law of big numbers, right? Sometimes it gets to a point where a stock gets to a big enough number, it just doesn't have any more buyers. Sometimes for the first time in history, companies have had so much cash on hand that it no longer justifies expanding the business model. Expanding the business model will actually just hurt their bottom line and their revenues, so that it's time to artificially inflate by buying back the stock. And in my opinion, they should just increase the dividend a little, but each company has its own CFO and CEO that make those decisions. All right, guys. Hey, I appreciate you being here with me tonight. Again, this will get posted here most likely tomorrow evening. I'll check with Dave. I appreciate you all being here. Brentons, thank you for being here the first time and participating. I look forward to seeing you next Monday evening, 6 p.m. Mountain Standard Time. And don't forget trade findings and adjustments this Thursday, 10 a.m. Mountain Standard Time with Key Bybee. You guys take care of yourself. Have a good evening. Bye-bye.